Stock market investing is an investment that anybody can get into and that they can use to build wealth. I say this simply because there are shares that trade for 10 rands and even 5 rands, and I believe that anybody can afford to buy shares at that amount at the very least. Most people want to get started with investing in shares, but they don't know where to start. And if you are the person, this video then is for you. Hi guys, how's it going? It's Raton Check and welcome back to my YouTube channel. Let's look at the 10 things you need to know before you start investing. And please note that none of my videos constitute as financial advice. This is not financial advice. I am not a financial advisor. This is for educational purposes. First things first, you need to know why you are investing. Are you investing to grow your wealth? Are you investing because you want to buy a home in the coming 10 years? Are you investing because you want to retire comfortably? Define a goal, because that is going to help you in selecting a strategy that is going to work perfectly for you to ensure that you are going to achieve your goal. For example, if you are investing because you want to retire comfortably, and if you are in your 20s or 30s, then you're going to invest for, let's say, 30 to 40 years. Then understanding that you have so much time to stay invested, then you can invest in ETFs or stocks that you know that by the time you require, your money would have grown by maybe 20% or even 50%. And if your goal is to buy a home in the coming 10 years, then you have to be very much careful, because you cannot invest like somebody who invests to retire comfortably. Remember, they have 30 to 40 years in the market and you only have 10 years in the market, and that is going to help you actually in selecting the best stocks or ETFs. If your goal is to exit the market in 10 years because you want to take your money and buy a home, then you have to choose ETFs and stocks that you know for a fact that in 10 years they're capable of returning you whatever desired return you want, that is going to help you in buying that first home. Remember, not all stocks or ETFs are going to double your money, either in 40 years even, or even 10 years. So if your time in the market is that short, then you have to be aggressive, because you have to put your money in stocks or ETFs that you know for a fact that they're going to return you so much in capital gains. So this will help you with strategy and determining your level of tolerance, which must be in line with your risk appetite. And the second one, understand that investing is not a get-rich quick scheme. And this is where most people miss it, because they think that once they put in 1,000 rands, then in the coming 3 weeks it's going to double to now 2,000. That is not how the stock market works. And obviously there are those companies that they grow so quick that within 3 months you could find that they have returned more than 100%. But understanding risk and return, those companies, they come with high risk, and you have to be okay with the risk that you are going to be subjected to, because your money can grow by 75%, and the following month it can crash down to negative 75%. But then high risk, high return, and this speaks also to your level of tolerance, your risk tolerance actually. So if you're going to start investing, you must understand that investing is not a get rich quick scheme. It's not a scheme where you're going to put in 5,000 and then in the coming 3 hours or 24 hours you're gonna double your money. That is not how it works. And that's why when we talk about investing, we often say that invest the money that you're willing to lose, because we understand that it might take you a long time actually to see those returns. And also, investing is for long term because we understand the time value of money, and that time actually will work in your favor. For example, if you're going to stay invested for 10 years, in the 10 years, should anything happen that is going to cause your investments to decline, there can be a correction, right? Or you have enough time to take that investment in company A and put it into company B and recover your losses. So you have enough time to rectify your wrongs if you are going to make those wrongs. Patience builds profits, and patience is needed in investing. You are never going to get it right if you are going to look at your investments every minute to see, how am I doing today? Or you're going to panic if you feel that today you are up 10% and then you now down 7% in the coming week. You are going to lose. Hence, I'm saying that patience builds profits, because the longer you stay in the market, the more returns you are going to get. And of course, that is only if you have chosen the right stock or ETF. And thirdly, start with what you can afford to lose. This is very much important. And obviously, because on this channel we talk personal finance, let me say this. Before you start investing, please make sure that you have enough in savings. Please make sure that you have built your emergency funds. Because if you don't have any savings and you now move to investing, trust me, you are working backwards, because life will happen and life will require you to get money. Are you now going to sell your investments because you have no savings, or are you going to resort to debt? And because now you would have started investing and understand that investing is for long term, you might not feel the need to sell your investments. So you might go resort to debt. So you're basically working backwards, because you have investments, you don't have any savings, but you have debt. And you're now unable to sort out your emergencies because you have no emergency funds. The money that must go to your investments is the money that you are willing to lose. You know that if you are taking 5,000 today and put it in the stock market, you know that tomorrow if you wake up and it is down by 95%, you will be okay because you don't need it immediately. The problem with putting in money that you cannot afford to lose, or take your savings and put them into your investments, is that should anything happen tomorrow and you had invested 5,000 today and whatever stock or ETF you have invested in has declined by 20%, when you sell your shares because you need that money because you now have an emergency, you are now going to get less than 5,000 because that money would have declined. And if your emergency requires 5,000, you're going to loan money so you can cover up that emergency. So really, it's not worth it. I would say go build up your emergency funds first, have those savings first before you move to investing. Because in investing, there is so much volatility. So much volatility that you can invest today and tomorrow your money has declined by even 20%. That is highly possible. So you cannot afford to put in money that you are not willing to lose. You cannot afford to lose. And also, this must be money that you're not even going to need in a year, actually, or even 3 years. Number 4, understand the risk. We all know that the higher the risk, the higher the return. But you also, individually, you need to know the level of tolerance you have. There are people that they are only saving because they don't have the tolerance for investing. They are not built for investing, right? That's what they say. So you need to understand yourself individually first and ask yourself, do you have the tolerance that the stock market need? Are you going to remain calm when everything declines? Are you not going to panic, end up selling prematurely? Do you have that level of emotional stability, actually? Because emotions can either make you or break you in the stock market. So if you cannot control your emotions, then you have no idea what your tolerance level is, and that is going to be a problem. But again, if you have low risk tolerance, that is not to say you cannot invest in the stock market. We do have ETFs. These are so safe, so much safe that anybody can invest in ETFs, and they don't even have to panic. They don't have to stress so much if they're going to lose all their money or not, because ETFs are diversified and they protect your money. So if your risk tolerance is low, I would say explore ETFs. But then also understand that the returns you're going to get there are not going to be too much. For somebody with a high risk tolerance, they can take the biggest risks ever. And these are the people that make the most money out of the stock market. Because when you take your money and put it into an ETF as a low risk tolerance investor, you are playing it safe, and that does not come with great returns. You could find that your ETF is going to earn you 15% per annum. And that person with a high risk tolerance, they're going to put their money in an individual stock and they're going to return 50% within 3 months. The difference between you and this person is that because they have a high risk tolerance, they're going to make more from the stock market. And you have to be okay with making that little because you don't have that tolerance that they have, and you need to be okay with it. So know yourself and understand who you are, and that you are not capable of putting your money into individual companies that come with high risk, because you just cannot stomach that. So I would say if you are that person, then look to invest in ETFs. And for the people that are only saving simply because they fear investing, they feel like they're not built for it, Just understand that you have low risk tolerance and ETFs can be the best for you. And number 5, understand that the stock market goes up and down. You are going to lose money today, you're going to make money tomorrow. That's how the stock market is. And I have said this in my previous video on investing for beginners, that the stock market is very much volatile. If you have not watched it, I will link it down below in the description box. And in that video, I talk about who investing in for and who investing is not for. And that video will actually help you in getting yourself ready to start investing, because investing can be for everyone. The problem is just the timing. You could find that I want to invest, but at this point in time, I am not equipped to start investing. That video addresses that. So with the stock market going up and down, the mistake that people make is that they sell. They panic sell and they think that they are going to lose their money, or they see that they are losing their money, so they don't want to lose any more money. Let me say this. You only lose money when you sell your shares. If your investment, let's say you're investing in Capitec, you see that your investment is down 10%. That is unrealized losses. Same with unrealized gains. You have not made losses if you have not sold. You have not made money, gains, if you have not sold. So if you stay invested in that company that is down 10%, tomorrow the share price can go up and you can recover from your losses. So you have not really lost your money if you did not sell your shares. And the mistake that people make, like I say, is that when they see the stock market going down, they sell, and they never actually question themselves, why is the stock market going down? And this obviously is on the law of demand and supply, and understanding also the company that you have invested in. Fundamental analysis is very much important. You need to understand why you even chose to invest in that company, because then if you have no idea what you invested in, when the share price declines, you're going to panic because you have no idea what is happening. What I often say in my coaching sessions, consultations, or master classes is that understand the company, because then if you understand the company, you will have an idea, you will have answers as to why the share price is declining, because you will have an idea actually that, okay, I'm investing in company A, and at this point company A is experiencing this and that, and these are macro issues, not micro issues, then it's okay. But if then these are micro issues, you might have to sell your shares, because then the fundamentals are changing. So if you are aware of the companies that you invest in, you are going to make smart investment decisions. Either that means exiting and selling your shares, or investing more. For as long as that your decision is informed, then it is a smart decision. So understand that the stock market will go up and down, and that's just how it is. So to just demonstrate this, right, if we look at Capitec Bank share price movement for the past 6 months, if you look at near that April 2025, we see that the share price had declined so much, but now it is up. So when we say that the stock market goes up and down, is that the share price does not stay at the same price at all times. Today is going to be 100 rands, and then tomorrow it might be 150, the following day might be 80 rands, and then the next day it might be 300 rands. The stock market will go up and down, and that is because the stock market is affected by a lot of things and people's emotions as well. And those things, they happen all the time. And that's why if your focus is just short term, you might think you're losing money, but if you look at it from a long-term perspective, you are going to make so much money. Because now, if let's say in April the stock price declined from 100 to 50 rands, and you panic sell, and then a year after the share price goes up to 300, the people that had stayed invested are going to make more, and you have lost actually. So with stock market investing, understand that the share price is going to go up and down, and also have a long-term perspective, because in the long term, the stock market will correct. Whatever that were hiccups in the short term, they're not going to be visible even in the long term. And number 6, understand that diversification protects you. By diversifying, actually, we mean have investments in different industries. If it's in South Africa, have your money across different industries, and have your money in different countries, and this will protect you. Because let's say now there's a, like the banking sector is crashing, né? And you have all your money in the banking sector, you are going to lose most of your money. But if you have a portion of your money in the banking sector, a portion in the property industry, a portion in the health sector, then when the banking is crashing, at least you know that you have 2/3 of your money in other different industries that are not crashing. So your performance there is getting averaged out. So you are not just losing money like that. At least you could find that if you are losing 100 rands because you have your money in the banking sector, and in those other two industries you are up 200 rands, right? At least you know that you have made a profit of 100 rands, because if you were to sell, you would take losses of 100 rands in the banking sector and take gains of 200 rands in the healthcare and the property sector. So at least then your profits and your losses there are offsetting each other, and you could remain with gains. So diversify, diversify, diversify. And if maybe you don't want to have a lot of stocks in your portfolio, then look to invest in ETFs, because ETFs already are diversified. For example, there's top 40 ETF, right? That has the top 40 largest companies in South Africa. And these companies operate in different sectors. That is diversification. You won't even have to worry about one sector crashing and you losing all your money, because if one sector is crashing, then you know that you have maybe 7 other sectors that are doing well. So you are not going to lose as much money as you would if you had your money, all your money actually, in just one sector. So diversify. And another thing that most people make is that they think if they take their money and put into, let's say, Absa, Capitec, FNB, and Standard Bank, they think they're diversifying. You are not diversified, because you still have your money in one sector. And should anything happen, you're going to lose most of your money because you are heavily invested in one sector. That is not diversification. By diversifying, we're saying have money in different industries, have money in different asset classes, have money in different countries and different markets. That is diversification. And number 7, fees eat your profit, right? So make sure that you choose an investment platform that has the lowest investing fees. Always make sure, because with these platforms you have to pay to use them. So go with the one that has the lowest fees ever. And with even investing as well, when it comes to ETF investing, you could find that you have an ETF that is going to cost you 1%. If you invest in it, they're going to charge you 1% per annum. And then you have another one that is going to charge you 0.05%. You must go with the one that charges you 0.05%, because you have to go with the one that has the lowest fees possible, because these are eating your profits. If let's say you now have 1,000 rands invested and their fee, maybe let's say it's 1%, they're going to take the 10 rands from the 1,000 rands from your investment. So make sure that you don't make a mistake of investing with the platform that has the highest cost or ETFs that have the highest cost. And number 8, learn before you start. Understand the stock market. And my channel will help you understand the stock market, so that when you start investing, you have an idea of what you're getting yourself into. Understand what the stock market is, why it's even there, how to make money on there, how to manage the risk of losing your money, how to diversify. Just understand what the stock market is, what stock market investing is, and everything that comes with stock market investing. And I have seen people that have taken so much losses that in the long run they could have turned into profits, and that is because they had no idea what they were doing. They were just investing because investing is a thing, and in this day and age people talk about investing, everybody is investing. So they wanted to start investing and they had no idea what they were doing. And now when they come for consultation and I'm saying, okay, I'm taking you through what the stock market is, what stock market investing is, and they're like, oh, actually now it makes sense, and I have sold this and that, I have taken this much in losses, and when we now look at that company or that ETF, it has done well in the past 3 years or 5 years. And that's the problem with just investing, because you have no idea what you're doing, so you are just investing. You will end up taking huge losses that were not losses. They were losses at that point in time, but understanding that the stock market fluctuates, had you stayed, you would have made your gains. So a little education prevents losses later. And one thing that you must also do, even if you do understand stock market investing at the basic level, never stop learning. Never stop learning, never stop reading books, never stop watching the content on investing, because there is always something to learn. Stock market investing has a lot of things that if you were to just study it maybe today and finish, tomorrow you might forget other things. But if you continue watching this creators, read books, you will then over time have a full understanding and remember everything about the stock market, that when something happens in real time, then you are able to respond, because you have an idea that, okay, this is happening because of this and that, so I don't have to sell. Or actually, we are having this issue, so I might have to sell. So always stay educated. And number 9, time in the market beats timing the market. When you time the market, you are actually speculating to say, if you buy these shares today at 50 rands, next month they're going to be 100 rands, and then you're going to make 100% in gains, right? That is you timing the market. But when you are concerned about time in the market, you understand that in 5 or 10 years, you are going to get gains. It does not matter at what percentage. And that is you understanding the power of the time in the market. Because if your perspective is short-term perspective, you're going to take many losses, because a lot happens in the short term that it's going to look like you're losing money. But if you look at the longer term, you're going to make so much money. So time in the market is very much important. You are not always going to win if you time the market, and you're going to be disappointed at all times. Yes, we might speculate that these shares are going to increase, in the coming year or 2 years, but with what percentage, we have no idea. And this goes back to investing money that you are willing to lose, because if you now take money from your savings and you put them in the stock market, knowing that this company, the share price value is going to go up, you are never going to be sure by how many percent, right? They might go up, yes, but with how many percent, you have no idea. So you would have disturbed your savings now to put money into your investments, because you had speculated that the share price is going to go high. But with that percentage, you have no idea. So never time the market, but rather be concerned about your time in the market. If you have been investing for a year and you feel like you are not seeing the results, if you have trust in that company and in that ETF, maybe stay invested for a little bit longer, and your story there is going to change, because the share price might increase. You have no idea. And the last one, start small and stay consistent. There's what we call dollar cost averaging or rent cost averaging. This is where you just invest money every month. If it's 100 rands, you invest it every month. If you think about it, in the coming 10 years or 30 years, that money is going to be a lot. And when you take it out in real time, it does not feel like a lot of money, because it's only 100 rands or 200, and it does not burden you, it does not feel heavy. So start small, especially if you are a beginner. Start small and see how the stock market is moving like, and build confidence, because experience is the best teacher, and your time in the market also will teach you a lot about stock market investing. So instead of just starting with a whole lot of money, start small. Really start small and build that confidence, because you are going to need it. And also, if you are somebody who believes that only rich people can invest, then no, you are wrong. With any amount of money, you can start investing. And if you only have 100 rands to invest, trust me, you can invest that money and it can compound to a whole lot of money. You don't need so much money to start investing. You don't need to have 10,000 to start investing. There are shares that goes for 100 rands, 20 rands, 12 rands, and you can buy those shares. And what I like also about the platform that I use Easy Equities, is that Even if your share price is 100 rands and you have 50 rands, you can still buy shares in that company, because it allows fraction purchasing of shares. So with whatever amount of money you have, you can start. And if you are a beginner, especially, start with small amounts of money and build up that confidence. And once you get the hang of things, then you can increase your investment contributions. And with that being said, we have come to the end of the video. Thank you so much for watching. I will see you in my next video. Do watch out for this investing for beginners video, because they are going to help you a lot. This is my commitment to help you get started with investing so that you don't get left behind. So don't miss them. Turn on that notification bells so that all the time when I upload a video, you get notified. Once again, thank you so much for watching. I will see you in my next video. Bye.